Good morning, everyone, and welcome to Tricorp's virtual fall forum. Although we're unable to meet and socialize this year in person, we're able to bring to you our fall forum featured speaker of 27 years, Mike Schenk. Before I introduce Mike, I'd like to go over a few housekeeping items. First, if you've not already done so, please mute your microphones, whether you are on a computer, telephone, or a cell phone, until it is time for questions and answers. At that time, if you have a question, please state your name and the organization you are with, and then ask your question. If you prefer to type your question in the chat box, feel free to do that as well. And note that you can select whether what you type in the chat box is seen by everyone or just by whoever you intend. At the end of the first session, we will have a half-hour break before Mike comes back on at 11 o'clock. You can either leave your link connected or disconnect and use that same link to reconnect after the break. And finally, the Zoom meeting is being recorded. Should you want to refer back to it, share it with volunteers, directors, or employees. I will be sending out that link to you at some point. Now, most of you know Mike and have heard him speak at various webinars and Zooms this year. But for those of you who do not know Mike, he is the Deputy Chief Advocacy Officer and Chief Economist for CUNA. He also happens to be the board chair of Summit Credit Union in Madison, Wisconsin, a $3 billion financial cooperative with over 160,000 members. He has 35 years in the financial services industry and brings to you a wealth of knowledge regarding today's economic outlook. That said, welcome, Mike.
Thanks, Denise, and good morning, everybody. I got to tell you, I was getting kind of nervous there. I was wondering if you wanted me to sing the forecast, and I'm not so good at that, so as you know, from the fire pit. But I'm really glad to be with you guys today and to give you a general sense of what we're thinking about the economy and the way forward and how we think that's going to affect credit unions and credit union interactions with members. I really wish I could be with you, obviously, hopefully next year, fingers crossed. But I do think that the conversations that we have are really important, not so much because I have a specific forecast to give you, but just sort of to level set and, again, give you a national outlook. But the most important thing, obviously, when we're together is that you have rich conversations with one another that help you to sort of noodle through what might happen at your credit union over the next year. So unfortunately, we don't have all of that, but we do have a semblance of normalcy here in that I have a really great PowerPoint presentation for you. Once again, I have probably about 4 hours of stuff to put into a 2-hour bag, but I'll do my best on that. And of course, it wouldn't be a Tricorp Fall Forum without a test. And so if the technology holds up, we will do a real quick test pre-test before I dive into the PowerPoint. And Joe will assist me on that front, if I'm not mistaken. Is that right?
That's right, Mike. We're good to go whenever you want the first question to come up.
Okay, why don't we do this really quickly? We only have 5 questions this year. You may recall, if you've been with us in the past, there is a real big payoff for answering these questions correctly. It's a lucrative prize, which will be awarded the next time we convene face-to-face. So without further ado, the first question, Joe, is: the economy contracted at a rate of almost 35% in the second quarter of 2020. How will GDP change in the third quarter of the year? So basically, we're through the third quarter. How do you think the economy performed over the last 3 months or so? Everybody vote, and in a moment, we should see the distribution.
Looks like there's still some people thinking, Mike. And I think we're about done with the voting. So one more second for whoever wants to get their vote in at the last minute. And we'll end now. And here are the results.
Oh, wow. Pretty evenly divided. Okay, well, we'll talk a little bit more about that in the presentation. The correct answer on this one is, or the most correct, it's not precise, but the most correct answer is the last one, increased by 20%. Okay? Second question is, the US unemployment rate peaked out at almost 15% in April, and it's come down really significantly, dropping by about 1.5 in each of the last 4 months. So we're down to 8.4% according to the Bureau of Labor Statistics. What's that unemployment rate going to be at the end of, not this year, but next year, 2021? Is it going to be about the same as the peak level in April? Is it going to be 10%, which of course was the peak level in the Great Recession? Is it going to stay right around where it is at the moment? Or is it going to decline a bit or decline significantly?
Still some votes coming in. And I think that's about it.
Okay, I expect to not see as much of a distribution, an even distribution on this one, because this is one that you probably pay a lot more attention to compared to the overall GDP of the economy. So that's the correct answer, the one that most people chose, 6.5%. Okay, so now let's go to the third question. Credit union aggregate loan net charge-off rate, so that's charge-offs net of recoveries divided by average loans outstanding, was 0.56% in 2019. That's throughout the nation. It declined actually to an annualized 0.52% during the first half of 2020. It's amazing what $3 trillion can do. So that number actually came down in the middle of the worst economic crisis in our modern history, really. So the question is, what will the credit union net charge-off rate look like next year? Sitting at 0.52% annualized, mid-year 2020, what's it going to look like next year? Is it going to go down to 0.45%? Is it going to stay about the same? Or will it increase? And if it increases, is it going to increase a little bit or a lot?
People are voting. Still a couple votes coming in. And it looks like that's about it. So you ready for the results?
Ready for the results. And that's the correct answer, 0.75. Half of you got that correct, so good. Now we're tracking all of your votes and we know who's got the correct votes, so this is all going to work into the awarding of the big prize. Question number 4 has to do with bottom line results. What will credit union earnings look like over the next year, 2021? So ROA, you may recall last year at credit unions throughout the United States was at a cyclical high, 0.93%. It dropped to 0.57 annualized in the first half of this year. Credit unions were, waiving fees and adjusting loan payments and that sort of thing. Obviously, interchange income came down a lot. A lot of mortgage refinancings, of course, took some high-yielding loans and sort of shoved them into portfolios that were much lower in terms of yield. And the other thing, of course, is we saw this massive increase in savings accounts, which essentially meant, in the face of weak loan demand, that very low yielding investment portfolios were growing and growing very quickly. So what's that going to do to ROA? Will these trends continue, or will there be sort of a rebound? And you might want to think back to your answer, or at least the correct answer, on the previous question before you answer this question. In 2021, what will ROA look like? Will it be negative 50 basis points? Will we be losing a lot of money, negative 25 basis points? Will we break even, or will we earn just a little bit less than what we've earned in the first half annualized, about the same, or get back to normal in terms of what happened in 2019? Probably not normal, but cyclical peak levels of 0.93%.
Looks like most people have voted.
Okay.
And here are the results.
I see. Okay, so about half think that it's going to stabilize at about 50 basis points, and a similar percentage, was 40%ish, say that it's going to decline to 25 basis points. The correct answer is 25 basis points. And finally, the fifth question, aggregate credit union net worth. I just talked about the massive increase in deposits. In the introduction, Denise noted that the credit union I volunteer for has $3 billion in total assets. That was pre-pandemic. We now have $4.5 billion in total assets, and I'm not sure we want all of those assets, but that's what happened. So we had this huge increase in assets in credit union land because the deposits were flowing in, stabilization deposits for the most part were flowing in. That pushed the aggregate credit union net worth ratio down from almost 11.5%, near an all-time high, to 10.5%. So we lost almost 100 basis points on the aggregate net worth ratio in essentially 3 months. What will the credit union net worth ratio look like at the end of 2021? It's going to be higher or lower? And actually, this is, will it return to where it was, or stabilize, or go substantially lower, or a little bit lower?
Still have a few people voting. And I think that's pretty much all those that are going to vote. So the results are...
Awesome, okay. So I would say the correct answer is, the most correct answer is 10%, which is what most people chose. And 9.5 is a pretty good answer too, so we'll give you credit for that one as well. So I hope you enjoyed the test. I repeatedly said the correct answer is, and of course there really isn't a correct answer. I just wanted you to sort of focus on what we were thinking in terms of what the future holds, and again, how credit union operations and financials will be affected in the current economic environment. There's a ton of variation in these numbers, as you know, not simply based on credit union asset size, but based on where you're operating in the country, because what you're experiencing, of course, is a lot different than what we're experiencing here in Wisconsin, or what your peers are experiencing in California or Arizona or Florida. This is just kind of a level set to get you to think about, in general, the pressures that we think credit unions will be wrestling with. And we won't choose a winner based on how you answered those questions. Essentially what we'll do is we'll reward somebody for actually taking the time out of their day and attending the Zoom meeting. And so we'll put all your names in a hat, and we'll pick one volunteer, if we have some volunteers here, and we'll pick one staffer and again, present the awards next year, hopefully when we're back face to face. So, any questions about any of that before I run through my PowerPoint? I'm going to have to do it pretty quickly, it looks like. Okay, I'm just going to share my screen then. And as Denise said, you can feel free to unmute and interrupt me at any point. I'm hoping that you can see this.
Yes, we can, Mike.
Sometimes takes a minute. Okay, I just have to adjust what I can see. Cool. Awesome. All right, so a couple things. I do want to, you know I do this almost every time we talk. In the current environment, I think this is the best starting point. Talk a little bit about the credit union difference and some of the differences that we're seeing in the marketplace today. Believe it or not, when we went to the GAC this year, actually a month before we went to the GAC, I engaged with Morning Consult, which is a survey research firm. We interviewed 2,200 US adults throughout the nation and came up with survey results that gave us a margin of error of plus or minus 2%, okay? And what we wanted to know was whether people, consumers generally, not just credit union members, whether people generally saw credit unions as being different in the marketplace. And what I was trying to do here is set the stage for what we hoped to be one of the linchpins of our advocacy efforts going forward. What we have found after the 2018 election was that we were, our messages were being bifurcated to a certain extent. Because when we went to the House, basically what leadership in the House wanted to hear was what credit unions were doing from the perspective of protecting consumers. And what we were doing in the Senate and within the administration was talking a lot about regulatory burden. Well, in the House, they didn't want to hear about regulatory burden. So we were in this situation where the messages had to be adjusted depending on the audience. You know, that's not surprising, of course, but it was a lot more obvious since 2018. And what we were thinking about was, you know, what would be the messaging that we could use, the focus of our advocacy efforts going forwards, where we didn't have to worry about the mixed messages or the adjusting messages. And what we, as you may recall, if you were at GAC, one of the things that we were focusing on or hoping to focus on was financial well-being. How credit unions address the issue of financial well-being, how credit unions enrich members' lives, and the difference in experience that credit union members have relative to what bank customers have. So we went out with this survey. We asked a number of questions, but three, I think, kind of rise to the top. One of the things we found was that consumers were 2 times more likely to agree strongly that credit unions act in consumers' best interests and are good corporate citizens than to say the same thing about banks. This is incredible from my vantage point because this is all consumers, not just credit union members. Recall that about 1/3 of consumers are credit union members, and so this is 2/3 of consumers generally also saying this sort of favorable thing about credit unions. So that was pretty powerful. About 2/3 were about 2/3 more likely to agree strongly that credit unions provide great customer service, financial value, and consumer-friendly products and services. And this, of course, works back to the member benefits that we've talked about quite a bit in the past. You know, lower rates on loans, higher savings yields, and fewer and lower fees, for example. So that was really powerful, I thought. And then 55% more likely to agree strongly that credit unions treat customers fairly, abide by laws and regulations. And that wording there, abiding by laws and regulations, was I was thinking specifically something that we could serve up to the to the Democrats in the House. So in any case, really significant results that show not just credit union members and not just credit union PFI members, but consumers generally really do recognize the credit union difference that we talk about all the time. I've said this before, and I probably presented this graphic last year, but just as a reminder, credit unions were created during the Great Depression by Congress as a separate class of financial institutions. And the reason that was done is because Congress recognized at that time that if we had member-owned institutions, that those member-owned institutions would view capital differently. That for-profit institutions, the banks, which weren't lending in the Great Depression, that the banks essentially were focused on what they're supposed to be focused on, and that is maximizing shareholder value. Or in the case of a crisis, like the Great Depression, minimizing the hits to shareholder value, protecting shareholder value in a crisis. And credit unions are much more likely, because of the structural difference, to view capital as essentially a war chest to be built up during good times and to be used, not used up, but to be used during crisis situations to help average people get to the backside of these crises with as little disruption as possible. So I've now lived through 3 of these crises, the one we're in at the moment, the Great Recession, and of course the S&L crisis and banking crisis in the late 80s and early 1990s. And this is how credit unions behave. This is an index of credit union and bank lending in the wake of the Great Recession. And you can see that, banks really did pull back in a significant way, and their lending volumes remained depressed for a long period of time, years after the conclusion of the Great Recession. In contrast, credit unions did stay engaged and continued to lend, not only in the teeth of the crisis, but for many years after the crisis as well. It's kind of a big deal. We're doing what we're supposed to be doing. So in the COVID-19 pandemic, what we're finding in our research, 95% of credit unions offered loan modifications. Larger institutions were more likely to offer loan modifications. So about 99% of members belonged to a credit union that offered loan modifications. 90% were waiving fees. 86% created new loan products, actually, to meet members' needs. And kind of got ahead of myself there, but you can see collectively credit unions originated about 200,000 Paycheck Protection Program loans, totaling roughly $10 billion. The average size of those loans was a hair under $50,000, and that's half the total that we saw at banks. And so it really was the case that credit unions weren't making loans to professional sports teams. They weren't out there making loans to big national chain restaurants. They were firmly focused on Main Street, mom and pop, independent businesses at the local level. It shows up in the data. Cornerstone Advisors actually did a study, and that study showed that credit unions had the biggest jobs-related impact per million lent of any of the lenders that participated in this program. So it's a really big deal. And as you know, we talked about this in the past, coming out of the Great Recession, because we behaved differently, there was a payoff in terms of growth in memberships, really strong growth in memberships that was pretty consistent over a long period of time. And so we expect, based on the behaviors that we're seeing today, that this will probably occur again on the backside of this crisis. And I wanted to put this up front because a lot of the stuff that you could tell from the test, a lot of the stuff that I'm going to talk about over the next half hour or so is it's not dire, but it's certainly not a rosy forecast. And I think it's really important in that context to recognize that there will actually be a payoff for what we're doing. There will be a payoff for perhaps some of the sleepless nights that you've had and maybe will have in the near future. That's really, I think, an important component of our outlook. It really is the case that we're supposed to be nervous because we are engaged and we're helping people in a very uncertain environment, and an environment that may actually deteriorate going forward rather than improve. Okay, so let me talk a little bit about the economic outlook. In order to do that, of course, I have to step outside of my comfort zone and think not so much about economic metrics, but think about on an ongoing basis, not just a weekly basis, on a daily basis, think about things like this. The course of the COVID pandemic really is driving, obviously, what's happening in the economy. Here's a picture of Coney Island on July 4th, not good. This could be anywhere USA. I could have pulled pictures from just about anywhere across the United States and come up with something maybe not as colorful as this, but that kind of thing. And it goes on. Not too long ago, there were about 500,000 people in Sturgis, South Dakota. Those people, according to phone records, I think it was Google maybe, that was tracking phones in this vicinity, half of the counties in the United States were represented here at the Sturgis Bike Rally not too long ago. And then schools have come back and we've had issues. Certainly, this isn't Wisconsin, but certainly here in Wisconsin, but obviously not relegated to Wisconsin exclusively. Across the country, this sort of behavior amongst young people, not super surprising, but it's happening, and it affects our outlook. It affects the outlook that we essentially depend on, that's coming from virologists, mostly in the Global Virus Network, but healthcare professionals in other organizations as well. This was just 2 nights ago. Whether you're thinking about these sorts of things, or you're thinking about our outdoor concerts or political rallies, these sorts of behaviors are actually pretty common, and that really works its way in to our outlook. So this is the national view on confirmed COVID cases. This is not the curve that we're trying to flatten. This is the number of confirmed cases on a daily basis. We don't need to flatten this curve. We need this curve to be going down over time. And according to the White House protocol, down for 2 weeks was the original advice on this, down for 2 consecutive weeks. And you can see, because of some of those behaviors that I just talked about, this is not headed in the right direction. And the essential bottom line here is that going into the crisis, early on when we put our forecast together, one of our key assumptions was that this crisis, by and large, the worst of it, would be in the rearview mirror by mid-year. It ain't. And so this is a really big deal. We believe that this is going to have, not this per se, but that the economic dislocation that we're wrestling with is going to have a much longer tail than we originally anticipated, and I think a much longer tail than a lot of people are assuming at the moment. Now, if you're looking for good news, the good news is that you shouldn't be looking at this graphic. If you're running a credit union, what's going to really matter is what's happening in your backyard and what that looks like. And so almost across the board in northern New England, the picture is entirely different. And for example, this is, can't see because this is Maine, all right? And it's hard to see, but on the far right-hand side of this graphic, there's a light-colored green bar. And that light-colored green bar means that the folks who put the graphic together, the folks at Johns Hopkins, believe that in the case of Maine, the data is actually headed in a favorable direction. And you can see the other part of that comment actually has to do with the very, very low number of cases that you're experiencing overall in the state. Not simply the direction, but the fact that the scale on this thing matters a lot, and you're very, very close to zero in terms of number of new cases. And the same can be said in New Hampshire, which really kind of surprised me when I saw this the first time a couple weeks ago, because of New Hampshire's proximity to Massachusetts and the Boston area in particular, and sort of the cross-pollination that occurs there because of that. but a very low level of cases. And again, you can see from the far right-hand part of this graph, headed in the right direction, and a green bar, which means, the professionals think, that things are headed in a favorable direction. Same thing in Vermont, virtually no cases in Vermont, probably in the top 3 states in terms of little effect. So this is all good news, I think, from the standpoint of the economies in your respective states and in terms of, the overall level of dislocation and expected dislocations going forward. So what I say from a national level, what you looked at in that test is actually probably going to be a lot more severe than what you all are going to experience, relatively speaking. Of course, as I said earlier, asset size and that sort of thing comes into play as well. Portfolio diversification of income stream, all of that sort of thing comes into play. But relatively speaking, in the aggregate, this suggests to me that you guys are in a much better place than the rest of the nation. The Census Bureau does a flash survey, a weekly survey of businesses throughout the country, and they ask businesses to tell them what sorts of effects that they're experiencing because of the COVID crisis. And you can see here, even though there have been few COVID cases in northern New England, businesses in Maine are actually telling the Census Bureau that this has had really big negative effects. Over half of the businesses that respond to the Census Bureau survey say that they've experienced large negative effects in Maine. Those numbers are substantially smaller. Those percentages are substantially smaller, both in New Hampshire and in Vermont, where about a quarter, a little bit more than a quarter of businesses answer in a similar way. The US average is about a third. And so, it's really obvious both in Vermont and New Hampshire that the opinions of business leaders tend to correspond to those graphics that I just showed you a minute ago. In Maine, there's a little bit more of a disconnect. So this again is generally good news, maybe not if you're in Maine, but in New Hampshire and Vermont, in my estimation. So here's what's happening from an economic perspective. I think I said in the test, the economy contracted at a rate of almost 35% in the second quarter, and we believe that it will expand at a rate of about 25% when we get the numbers that show what just concluded, the 3 months just concluded. So the third quarter we expect, because the economies throughout the United States have opened to a significant degree, there have been more not just social but economic interactions on the part of consumers, who represent 70% of economic activity, that we will see this big bounce back, 25% growth in the third quarter, and that'll come down significantly in the fourth quarter as we see not only a resurgence of the COVID deaths that would be reflected in the increase in the number of cases, but also with concerns over the regular flu that people experience, seasonal flu. You know as well as I do, we live in similar areas from a weather perspective. We have about a month left where people can go to restaurants and sit outside and do all the social distancing. Many of the restaurants around, Madison, Wisconsin, where I live, I think when we get into November, they're going to have a tough time with the mandate here, which calls for 25% occupancy on indoor businesses like restaurants. Many restaurants, if that mandate prevails, many restaurants that are in operation today that have sort of limped through to this point simply won't make it. So we're very, very concerned about that. In any case, you can see our GDP forecast for the full year, 2020, is a contraction of about 3.5%. We think the economy is going to grow by about 3.5% in 2021. That means at the end of 2021, we're probably back close to where we were in 2019, but we've basically lost 2 years of economic growth, which is kind of a big deal. Okay, now don't look at this graphic and conclude that this is going to be a V-shaped affair. As I said earlier, we are very, very concerned about the tail, and part of the reason that we're concerned about the tail has to do with labor market. Now you can see, I talked about the US unemployment rate peaking out at 14.7%. In both New Hampshire and Vermont, those unemployment rates rose even further. In Maine, peaked out at about 10.5% in April. And since that time, we have seen a steady decline for the most part, Maine being a bit of an exception in July. But for the most part, nationally and in northern New England, we've seen a declining trend in the unemployment rate. And that's good news overall, but I'm very cautious about, being real excited about the declines that we're seeing for a couple of different reasons. One, this decline to 8.4% in August is occurring against a backdrop of a decline in the participation rate. So labor force participation rate was about 63.5% prior to the beginning of the downturn. It's down to about 62%, a little bit under 62% at the moment. In addition, about 250,000 of the folks who have become employed over the last several months are employed as census workers, part-time census workers. Those jobs will go away in several months, presumably. Another really big part of this is that the folks that are unemployed, many of them now are telling the Labor Department that they are permanently unemployed. And that means that the jobs that they left will not be there for them, when things get better. The businesses have closed. And therefore, they're going to be in a position where they're going to have to look for an entirely different job and perhaps an entirely different occupation. Going into the downturn, about 500,000 people had told the Labor Department that they were permanently unemployed. 500,000. That's up to 3.5 million today. And so, this is a hopeful sign. These improvements are, something that we like to see, but, the underlying data paints a less rosy picture than what you see here. Our forecast calls for the unemployment rate to finish this year at 8% and to finish 2021 at 6.5%, which of course would put it almost at double the level that we were at going into the downturn. So that's kind of a big deal. If we're right, 6.5%, again, parenthetically, is lower than the peak level during the Great Recession when we had an unemployment rate of about 10% at the peak. Okay, now here's part of the reason that we're really very concerned. And this is a graphic that I've showed you before, so I'm not going to spend a lot of time explaining it. But it does go back to the beginning of time. As you know, I define that as the year I was born. So this is 9 recessions and what happened to the labor market, the number of people that were employed or as a percentage of the total labor market in each of those downturns. I was hoping to never have to update this graphic, but here you go. In 1960, we had a downturn wherein we lost 2% of the jobs that were outstanding at the beginning of the downturn. Took about a year to get those jobs back, actually almost 2 years. And then this is the next recession, 69, kind of similar, and that's the 73 recession, lost more jobs, took about as long to get them back. And this is the first dip in the double dip recession in the early 1980s. It wasn't very severe. We lost only about 1.5%, 1.5% of the jobs during that downturn. It took only about a year to get them back. This is the second dip in that double dip recession. And collectively, those two together, of course, were the most severe downturn since the Great Depression up to that point in time. But lost about 3.5% of the jobs, and it took well over 2 years to get those jobs back. Here's the 1990 recession, where it took almost 3 years to get the jobs back, although we lost fewer. And then 2001, where it took about 4 years to get the jobs back. The Great Recession, you'll recall this one, everybody kind of went when I showed this the first time, and this is what we're living through today. So we lost over 14% of the total jobs that existed in the initial severe lockdown. And then we had this bounce back effect, and we're still down about 8%, a little bit less than 8% of the total jobs that were outstanding at the beginning of the downturn. Our guess is that we will not return to pre-recession levels on this reading in terms of the total number of jobs for well over a year. So that 6.5% at the end of 2021, if we're right, is going to still reflect a pretty significant decline in jobs overall. And we're probably looking at 3+ years to get back to normal. So that's kind of a big deal. One of the big reasons that we believe this is related to this idea of permanent job loss. There are 8 million business establishments in the United States. About 3/4 of those business establishments are operated by fewer than 10 full-time equivalent employees. And about a third overall, 2/3, 60% are operated by 5 or fewer full-time equivalent employees. Moody's Analytics did an analysis of this. There are a couple of firms that did, and I've looked at those analyses. Moody's kind of falls in the middle. And what they were saying not too long ago was that a projection of about 1 million business establishments lost would not seem unreasonable. So 1 out of 8 million business establishments, according to their analysis, would not make it to the back end of this crisis. Kind of a big deal. I saw not too long ago the Coalition of Independent Restaurants did a study wherein they forecast somewhere in the neighborhood of 85% of small independent restaurants out of business because of this crisis, putting roughly 11 million jobs at risk. So that's kind of a big deal. And part of the reason that we think that the way out will be longer than a lot of people think. Jobs actually have been destroyed, and many more probably will be destroyed as the COVID crisis, works its way into 2021. We are not confident that a vaccine will solve the problem. There are too many people who are now saying, at least, that they have no interest in taking a vaccine. And the numbers that I've seen range from 25 to about 33% of people interviewed. That's way too many people not being vaccinated to have a significant effect on positive outcomes. So kind of a big deal there. I think what holds more promise, and again, I'm not a healthcare expert, so take this with a grain of salt, but it feels to me like one of the things that would be really helpful is to have widespread testing available with almost immediate results. That would make a lot more people comfortable with coming back to work. So from our perspective, it matters little what politicians are saying in terms of whether things are safe or not. It really matters how consumers are feeling. And in the Fed's July Beige Book, many consumers told the Fed that they would be reluctant to be going back to work, even if politicians or healthcare professionals said that it was safe, in the absence of a vaccine, in the absence of widespread testing, because they just simply don't feel safe. Almost an equal number of people, about a third of the people surveyed by the Fed, were saying that they were concerned about either childcare, what are my kids going to do, or the safety of the childcare setting, including schools, and whether or not kids would be coming home with COVID and infecting, the extended family. So that was a big deal. The other really big deal at the time, back in July, and it could become a big deal going forward, of course, if we see more stimulus, was the fact that somewhere in the neighborhood of a third of the people they interviewed said that they were actually making more money on the unemployment rolls than they were working. And so, why go back to work when the $600 unemployment sweetener was actually making them better off than otherwise. So these are all reasons that we think that labor markets will improve pretty slowly in the scheme of things. And we do think it's really a big deal. whenever there's a labor force disruption, and we've talked about, oh, and by the way, this is not just our view, the government is actually sort of thinking along the same lines. And CUNA economists' baseline forecast is generally representative of consensus forecasts we see both within the financial services sector and more broadly outside of the financial services sector. The job market recovery will be a long, slow affair. And we've talked about this in the past, but that makes us really, really concerned because we have a whole bunch of academic research that shows just being out of work for a short period of time has significant effects, not surprisingly, on financial health, on mental health, on physical health, on things like crime, on substance abuse rates, on domestic violence, and on and on and on. Bad things happen when people don't have jobs, or even in the case where people are concerned, nervous about losing their jobs. The sleepless nights add up. The fact that we're not interacting socially or we're being advised not to takes a huge mental toll, not just on adults, of course, but on kids as well, and that's kind of a big deal. So that's kind of our baseline. I do want to mention that going into the downturn, our members were in great shape financially. The S&P 500 actually has returned about 11.5% annually over the course of the last 5+ years. Annual average increases of 11.5%. So as we've talked about before, about 55% of households have an ownership interest in equity markets. Wealthier people have a lot more going on this front. But financial, this is not a financial crisis, which is kind of a big, at least not yet, which is kind of a big deal from a household perspective. Part of the reason that, overall confidence has been kind of surprisingly high for the most part. When we look at, non-financial assets, as we have historically, we see the housing market in great shape overall. Sales have been really strong. The supply of homes on the market is quite low, and this is helping to boost housing values. So we're not seeing the dislocations from a financial perspective or from a housing market perspective that we saw during the Great Recession, which is very, very important. Again, $3 trillion matters, and the support that the Fed has provided matters and matters a lot. When we look at the household debt service burden, it's at an all-time low. The pile of debt relative to take-home pay is at about a 30-year low at the moment. And so you wrap all that stuff together, net worth in the household sector as a percentage of disposable income is at an all-time high, or it was 1 quarter ago. If I updated this, you would see that the bar drops a little bit because equity markets declined at the end of June, but still quite strong from a broad historical perspective. Now, having said this, these are national overall numbers, and of course, people are talking about a K-shaped recovery. We've talked in the past about how both income and wealth disparities are obvious in the United States, and those disparities have grown over the past 30 years. In the current environment, as you know, COVID is disproportionately affecting folks on the bottom rungs of the economic ladder, and therefore we expect both the income and the wealth disparities that we've seen growing over time to become more pronounced over the next 18 months. And again, this is a real problem from a consumer perspective. I would argue that it also represents a really big opportunity for credit unions. I'm going to skip that graph, but it'll be in the handout materials. Basically shows you how people used their stimulus payments. Wealthy people tend to save a whole bunch. Those without a lot of wealth tend to spend everything or pay down debt. We've talked about that in the past. So here's our economic forecast in a nutshell. Because of what I just described, we believe the Fed funds rate will not change at all through our forecast horizon. You can see the 10-year Treasury just bumping around at current levels. And so what that means is, as I alluded to before, the net interest margin at credit unions will be under increasing or continued pressure as we go forward, if you believe this. So a couple things on the credit union forecast before we pause for a break. Our members were in great shape. Our members were in great shape in 2019, and because of that, credit unions were in great shape. Asset quality was at cyclical highs. The delinquency rate, 70 basis points nationally. The net charge-off rate, 56 basis points. Those were cyclical highs, very, very close to all-time highs. The return on assets, which we mentioned in the test, 93 basis points, was sitting at a cyclical high, and capital adequacy at almost 11.5% was near an all-time high. So this is what we think is going to happen going forward. We think the delinquency rate will go up and the net charge-off rate will go up. And part that's reflecting the fact that a lot of the stimulus that we threw at this problem will be going away. And we might replace some of it, but not enough of it to keep these payment rates current. And that's going to be a big deal. The real question is, we've seen big increases in allowance accounts, and we've seen big increases in loan loss provisions. I'm not exactly sure, when I look at the sort of the granular data, that there aren't a lot of credit unions out there that going forward will need to sock away quite a bit more in their allowance accounts. And so again, the loan loss provisioning more than likely will be something that will affect bottom line results going forward in significant ways. So that's sort of a continuation of the trends that we saw in the first half. And I think it reflects, again, when I look at individual institutions and I look at, for example, their coverage ratio on the allowance account, how many years of losses do they have in the allowance account? It seems to me like, those numbers on the provisioning will be pretty high continue to be pretty high going forward. The big deal, of course, is all of those deposits that have flown in, that have come into credit unions, have caused credit union capital ratios to decline, and decline pretty dramatically by the end of 2021. Now, we're not expecting to see the stimulus checks at the same level that we saw earlier this year, but we do expect to see further stimulus going forward, which will cause some inflows, relatively large inflows to credit unions. But the other thing that comes into play here is, well, actually two other things, or three. One is that equity markets may not hold up. We have not really experienced a flight to safety at this point. I think going forward, the longer this goes on, the more volatility that we'll see in the stock market, and the more likely that means that we'll see, more investors seeking the safety of insured deposits. So there might be more of that flight to safety going on. At the same time, we believe that many consumers, and we've talked about this before, somewhere between 2/3 and 3/4 live paycheck to paycheck. A lot of those folks will realize, actually we should have a rainy day fund set aside. And so there'll be more of a focus, to the extent it's possible in the consumer sector, more of a focus on building rainy day funds for the uncertainties that they'll be facing in 2021 and beyond. And then, of course, the other part of this that comes into play is pre-pandemic, we were experiencing pretty fast savings growth. And remember, that was due to a big demographic shift, baby boomers retiring, focusing more on savings and less on spending and borrowing. And that trend has not gone away. It's actually accelerated, and it will be more obvious, I think, at the back end of this crisis. So those are some of the things that credit unions are wrestling with. There is some good news. I'll spend just a minute or two talking about some of the details. We've seen massive mortgage originations. You can see this is first half data going back a number of years. 130 billion credit unions originated in first mortgages in the first half of 2020. That's roughly 90% higher than the previous record, which was about $70 billion. And there are a couple of effects related to this, of course. On the one hand, a lot of high yielding loans in other areas of the portfolio are being folded into these refinance mortgages. So that's putting downward pressure on yields overall. Of course, mortgages yield a lot less than many other types of loans. So there is that effect for sure. Obviously, almost all of the refinancing has been into fixed rate paper. And to the extent that credit unions are selling into the secondary market, they are reaping huge rewards with those sales. So many credit unions actually are experiencing a relatively high ROA in the current environment, mostly because of those gains on sales that obviously show up in non-fee, non-interest income. And then I was talking about net interest margin. This shows you the data. You can see that for the 5 or 6 years going into 2019, net interest margin was rising, and it fell to 289. It fell by, what would that be, about 26 basis points, I guess, in the first half annualized. That was due to a 36 basis point decline in asset yields and a 10 basis point decline in funding costs. So the decline in funding costs helped to soften the blow a bit, but you can see, we don't really expect a big increase in non-mortgage lending going forward. Rates will stay very, very low, we believe, and deposit inflows will continue at a pace. The good thing is that a lot of our longer term deposits, probably I would guess somewhere between a fifth and a quarter of longer term deposits, will reprice over the next year at lower rates. So that should be helpful. But that pressure will remain obvious. Operating expense ratios have declined a bit, mostly because assets have increased and increased strongly. So that's good news. And then here's the ROA picture that we see, about 50 basis points this year and 35 next year. And then what that means is, from a capital to asset ratio perspective, we're basically living through what we lived through in the Great Recession. If we're right, capital to asset in the aggregate will decline to about 9.5%, a little bit over 9.5%. And that decline from about 11.5 to a hair over 9.5 is almost exactly what we experienced in the Great Recession. So I'm going to pause there, and we'll give you all a break and come back in about a half hour. As Denise said, you can leave the link open, or you can relink in later. When we come back, we're going to talk about the election and the effects the election might have on this outlook, as well as the possibility of changes in leadership at the NCUA and some of our efforts from an advocacy perspective at the NCUA. And to help me do that, I'm going to bring in a couple of other CUNA experts. So come back in about a half hour at 10 sharp, and we'll open it back up and talk a little bit about the non-economic effects of credit union operations going forward. And then hopefully we'll have some time at the back end for a rich discussion on all of these issues. So thanks, and I'll see you in a half hour. Hey, welcome back, everybody. Thanks for hanging in there. When I talked to Denise a couple weeks ago, we were setting this up, and she solicited from you some questions. I was very disappointed to see that many of the questions had absolutely nothing to do with economics, but not surprised that many of them had something to do with the political environment and what was likely to happen with elections and maybe some of the implications of those outcomes. And so I, rather than having you listen to an economist's point of view on those topics, I've engaged Trey Hawkins, who's our Deputy Chief Advocacy Officer for Political Action. I've worked with Trey for a couple decades now, and just a terrific guy that really has his finger on the pulse of what's happening from a political standpoint. So Trey is with us, and if you wouldn't mind, Trey, just giving us your point of view and what you see happening and why you think it's going to matter.
Sure. Thanks, Mike, and good morning, everyone. It's excited to be here and join you, at least virtually, this morning. And rest assured that I get the pleasure of having a daily huddle every morning with Mike Schenk, and all of us inevitably have some sort of economic question for him that stumps him and sends him back to his team to try to dig up all kinds of data to answer the question. So he's getting plenty of economic questions. But you guys, as Mike said, we are 39 days from the election, and so I am going to very briefly share my screen. Bear with me one moment and find the right window. There we go. Because I've got a couple of little slides that I think will hopefully be of interest to everyone, is kind of how we're seeing the election right now, and importantly, how we at CUNA with our league partners are engaging in the election. I'll forewarn you, I know we have a brief amount of time. I really geek out on this stuff, so I could go, prattle on about this for hours, but I'm going to try to give a brief, overview, and then we can hopefully have some time for Q&A. I'm going to try to do two things. One, first up, I'm just going to give like pure analysis, how we are seeing the elections right now, and then I'll get into a little bit at the end as to our engagement, including recently just announced yesterday in your neck of the woods, so to speak. But first off, the question everyone has, the presidential race, we do not get involved, I think most of you know, in presidential politics in terms of picking a side or endorsing in any way. But we do monitor very closely what's happening. And what you have here on this slide is the Real Clear Politics polling average. This is a media site that has really good job going back multiple cycles of averaging reputable polls on a rolling basis, so you can smooth out some of the outliers in the presidential race. And this was as of Wednesday when I pulled the data. They have an average of Biden ahead 50 to call it 43, 7 points, 7.1 points. Now at that point, 41 days out from the election. I always like to try to put this into context, because we always get the question about, well, wasn't Donald Trump ahead of Hillary Clinton in the polling in 2016? So I always kind of go back, and Real Clear Politics has all this data. It's available, so it's great. In 2016, on the exact same day that I pulled this, Hillary was leading Donald Trump, but by a much smaller margin, 3.2%. And then in the final analysis, what this is actually measuring, these are national polls of the popular vote, the national popular vote, and at the end, the national polls actually on the national level were accurate in 2016. Sort of a misnomer that the polls didn't predict this. It's just that the national popular vote is not how we elect the president. We do it through 50 different state elections through the Electoral College. And so I throw that up there on the bottom left there. You can see Hillary beat Donald Trump in the national popular vote by 2.1%, which was in the margin of error of what this measure that we're looking at predicts, would have predicted in 2016. But of course, it's the state votes that count. But the thing to take away from this, I think, is that as you can see in the blue line versus the red line, Biden's lead has been pretty steady in a head-to-head, even going back before he was the nominee against Trump. So the state of the race has been pretty stable. And it's significant that even though there's a bias, as you may have heard, in the Electoral College towards Republicans, that is, when Hillary won the national popular vote by 2 points, it still wasn't enough because of the way votes are distributed in blue states and red states for her to win the election. But even though there's that,
I'm having trouble
bias,
understanding right now.
Biden's lead is sufficient enough that should predict an Electoral College victory, at least at this point. And when you look at the state-by-state polling and punditry and predictions, this is from a site, 270 to Win, that amasses all sorts of data. That's sort of what you see. The state of the race today, or I guess 2 days ago, has Biden just over, with the states that are leaning in his direction, just over the line, the 270 that he needs. What significantly changed for Donald Trump since 2016 is Donald Trump, if you look at this map, the toss-up states, North Carolina, Georgia, Florida, Arizona, Donald Trump won those states in 2016 and then pulled off an upset in Pennsylvania, Michigan, and Wisconsin, which was enough to give him an electoral college victory over Hillary Clinton. The current state of the race right now, a little over a month out, is Biden has polling leads outside the margin of error in those 3 states, and the battlefield is really being fought on the toss-up. The toss-up states right now are in North Carolina, Georgia, Florida, Arizona. The main 2nd congressional district, as you all know, you split your electoral college votes, and then Nebraska's 2nd congressional district. So Trump does have some ground to make up, because even if he were to win those, sweep those toss-up states, he still has to cut in somewhere in the light blue states in order to get over 270. So that's sort of the state of the race right now. As I say, we don't get involved in the presidential race, but we do get involved very heavily in the control for Congress. I shouldn't say not for control of Congress, but on behalf of credit union champions, Democrats and Republicans on both sides of the aisle, both chambers. This is the current state of things, the numbers right now. Democrats, of course, control the House. For Republicans to pick up control of the House, they would need to net 20 votes, or flip 20 seats, if you were. And for the Senate, it's a little more complicated because of the way the Senate works. The Republicans have a 3-vote majority. So if Democrats were to flip 3 seats, they would be a 50-50 tie, and then the winning vice president would presumably break the tie. So for Democrats to take the Senate, they need a comfortable margin of 4, because if Trump wins, but only 3 if Joe Biden wins, because in that case, Kamala Harris would be the president of the Senate in her constitutional role and could break the tie. So that's sort of the game, the landscape, if you will, the map. And this is what it looks like in real time. This is the Cook Political Reports ratings. This is an independent, nonpartisan rating group company that looks at all the polling in the country and tracks races and fundraising and everything. And this is the Senate map as it stands right now. So if, let's say for the sake of argument that Democrats want to take back the Senate and they want to, guarantee they get those 4 seats so they don't have to worry about the presidency. Their challenge is made a little tougher because Alabama, which is in that pink, leaning Republican right now, is represented by a Democratic senator who's almost certain to lose, Doug Jones, in a very heavily Republican state. So call that, from 4 to 5 they need to flip. But then you have similar situations in Colorado and Arizona, which you can see is light blue, lean D. Those are 2 Republican incumbents who have not led in hardly any polls all year and are likely to lose in states that are trending very blue. So now you went from 5, now you're down to 3 seats they need if you take those 2 in the bag and you have Alabama flip. And then the margin, the battle for control of the Senate really comes down to these gray states. Maine, where many of you are, Iowa, Montana, North Carolina, and Georgia's gray. There are actually 2 Senate seats in Georgia this year. Both are very competitive and toss-up. So that's a combined 6 seats that are heavily in play right now, and Democrats need to win 3. Obviously, Republicans need to win at least 4 of those as the map currently stands. So I would say anything is possible. We're still a month out, but it's probably at least a 50-50 chance that Democrats take control of the Senate, in my view. Maybe 55-45, 60-40, but there's still a lot of hole between the ball and the green at this point. But the other kind of key takeaway from this is, I don't think you're going to see a dramatic shift, because if Republicans retain the Senate or Democrats pick up the Senate, we're talking about maybe a 1 or at best 2-vote margin either way. So you're going to have more continued gridlock, as well as, the outcome of the presidency. And then in the House, I think most observers, and I agree with this, expect the House to remain in Democratic control. And here's why. This is the Cook Political Report. A lot of data on the screen. These are races that they've measured as competitive. But the big takeaway is that little bar, red and blue bar on the top right, that if you add up all of the races that are leaning one way or the other right now, except for the toss-ups, Democrats are already at the 218 majority seat. line, which is the majority they would need to retain control. And then you've got 28 seats that are pure toss-ups, roughly half Democrat, half Republican. But when you mix all this together, for Republicans to get even a single seat majority in the House, they have to, keep every seat they currently have, which would mean winning all of their toss-up seats and 4 seats that are leaning or likely Democratic, the current, as well as knock off 20 Democratic seats, which means, all 15 toss-up seats and then going pretty deep into Democratic territory. And it just doesn't seem likely. This does not mean that at the end of the day, the margin won't be closer or that Democrats won't lose seats. I think you're going to see some Democratic incumbents in a lot of the districts in the toss-up are in red areas that Trump's likely to win, and there could be a drag on the ticket there. But I think at the end of the day, while the margins might change, Democrats are likely still to control the House. So that is sort of the playing ground, but what is even more exciting for us and that we're engaged in heavily is what kind of a role can we play in this sort of battleground on behalf of credit union champions as CUNA, with our league partners, with many of you. And the first up is we have a very heavy get out the vote operation in voter access. If you haven't heard about our Credit Unions Vote campaign, I hope you'll check it out. We've put together a super user-friendly website called creditunionsvote.com. And the idea behind this, particularly in this during this COVID pandemic, when a lot of people are concerned about how do they vote safely. They may not want to stand in line on election day for hours. What are their options? And a lot of states are changing their voting options. They're making it easier to vote by mail, easier to vote early. They've created, some states have secure drop boxes where you can, hand in, your ballot. We're expecting to see record early vote turnout like we've never seen before this cycle. So what we've done is try to create a tool that credit unions can use to engage your members to in a nonpartisan way. To kind of educate them on what your options are. So you can log in, you can check your voter registration, confirm that you're registered, see what your ballot looks like, who's on the ballot, get all the details. If where's your polling location, what kind of ID do you need, and then if you're interested in voting early, it has all the options on there. You can click through to request an absentee ballot. You can find polling places, early polling places, which are sometimes different than the polling places you have. And what was really cool about this is that we've plugged it into every state's election authority. So as they're changing their rules, it's updated almost in real time, so you can get the latest and greatest. And then we've created a member activation program around it. If you go to cuna.org/map, M-A-P, we have a lot of templates and a toolkit with social media tools and templates and email templates that you can take, put in your own credit union's branding and push out to your members to just make sure that they know their options about how to vote. And then, so that's sort of our getting people out to vote and making sure that our 120 million credit union members exercise their right to vote in this crazy election year. But we're also heavily engaged in trying to elect a pro-credit union majority to the next Congress. And you can see on this slide just a lot of stats of what our engagement looks like. Our federal PAC, QLAC, has been able to raise, even in this pandemic, we're trending ahead of where we were in 2018. We've raised more than $4.5 million. We've distributed, over $3.5 million. We're on track to $3.7 million directly to congressional candidates. We picked the best candidate, Democrat or Republican, in every seat that is for credit union, for credit union issues and credit union support, and we try to support them with direct contributions. And we've been able to do that 391 times this cycle, including 33 open seats where there's going to be a new congressman no matter what, because the current incumbent is not running or retiring or running for something else. We think that's a great opportunity to identify a credit union friend and engage for them. And then you can see, our positioning is very evenly split between Republican and Democrats. And then we're really leaning into political advertising. So beyond just the contributions that we're contributing to the campaigns to support them, we're trying to identify champions who need a little bit extra help. In this cycle, we've announced just yesterday 4 Senate races, including the incumbent Senator Susan Collins in Maine, for those of you from Maine. And next week, we'll be announcing a whole round of House races that we're investing in. And our support for this takes every kind of form. It's direct mail, it's digital ads, we're advertising on Facebook, we're on YouTube, we're even experimenting this cycle with digital TV streaming services like Hulu, where we can deliver ads, in some cases even directly to credit union households, in working with our credit union partners. You see on the screen just some examples. And then I thought I would share, this is actually an ad that, for those of you from Maine, and I know the rest of you are near Maine, the Senate race in Maine is incredibly competitive. It's a toss-up. Susan Collins has been a champion for credit unions on a number of issues, from the Senior Safe Act to writing the PPP program to longtime advocate for expanding member business lending authority. So we went in and wanted to run some advertising targeted to independent voters to kind of tell that story in a very positive and uplifting way about how she has been supportive of not just credit unions, but the communities that she's serving. One of the things we try to do is not be negative. In fact, all of our communications are positive because we think there's a lot of negative communications out there around the election, and we want to cut through that clutter and give people, instead of a reason not to vote for someone, a reason to vote for someone. So if you'll indulge me, I was going to show this ad, and hopefully it will play through the presentation. And if not, we can share it, in the chat on YouTube. But this is an ad we've got running currently in Maine. Full service review of all these So someone give me a thumbs up if you were able to hear that at least. I've never.
No, I don't think you're sharing your audio, Trey.
Okay. Well, apologies. I will, the audio is fantastic. Hopefully you saw. If you
want to stop screen sharing, when you start again in the lower left, there should be a checkbox when you start screen sharing that says share computer audio.
Lower left.
When you click on share screen.
Oh, when you click on share screen. Okay. Oh, cool. Share computer. Yeah. All right. Let me try that again. You can indulge me.
We do full service repair of all makes and models. We was planning a big expansion. The COVID hit, and it was like somebody just shut the faucet off. And then I talked to Molly down at the credit union about this PPP application. It took less than an hour to do. We had the money in less than a week. It brought that stability that we needed, so we knew we was going to make payroll. We do full service repair of all makes and models. We was planning a big expansion. The COVID hit, and it was like somebody just shut the faucet off. And then I talked to Molly down at the credit union about this PPP application. It took less than an hour to do. We had the money in less than a week. It brought that stability that we needed, so we knew we was going to make payroll. That's the credit union, Small Business Association, and Susan Collins. And I'd just say thank you.
All right. Hopefully that was better. But that's just an example of the sort of advertising that we're doing for these credit union champions, Democrats, Republicans, House members, Senate members around the country this cycle. And our mission in doing that is just to, particularly these leaders who have been champions on credit union issues that find themselves in these tight races, if we can just lean in some positive way and share, why they have been important to credit unions and why they've been important to credit union members and the communities that credit unions are serving, that maybe that gives some of those voters who are still making up their mind another reason to consider, supporting that candidate. And then if we're successful, hopefully we have, a pro-credit union majority in the next Congress. So with that, I'm just gonna, I guess, turn it back to you, Mike, and be happy to, I know we've got a few minutes here, be happy to take any questions about either the outlook on the race or our engagement, participation, or any and all.
Awesome. Thanks, Trey. Really appreciate you joining us and sharing that point of view. I don't know if you all saw it, but in the ad, your board chair, Ryan, was featured in the credit union there. So very cool. Does anybody have any questions for Trey?
I've answered everyone's questions and predicted the outcome of the election and everything.
Let me just ask you one that I hear a lot. So let's just focus on the presidential election. Could you just give us a minute overview on, like, outcome-wise, if it's one person or the other, what should credit unions be thinking about or expecting in terms of?
Yeah. I think if President Trump is reelected, it is likely that we have continued divided government that's very similar to what we have now, because the Democratic House is going to, there's going to be a Democratic House, I think, no matter what. That seems clear at this point. If Trump is reelected, he likely is winning. Some of those swing states are the same states that have these competitive Senate races. So he likely, has a Republican Senate majority. So it looks come January very much like it does now. And I think for credit unions, the same types of things that we've been active on, certainly before COVID, regulatory relief issues and that kind of thing. With this current government lineup, we've been very successful in getting sort of that. But, there's still sort of this issue that is, even today, not fully resolved around sort of COVID response and another round of stimulus and what happens to the PPP program, and all of those issues that are going to be facing whatever administration is sworn in. If Biden wins the presidency, I think you are going to see a shift. I think it is a greater chance that there's a Democratic Senate, maybe by a vote or two, just a 1 or 2 seat margin. But you're going to see, a couple of things. One, they're going to want to, with respect to credit union regulation, sort of roll back or attempt to roll back some of the regulatory relief that we've had progress on over the last 4 years, as you might expect. Going back to the Obama administration that passed Dodd-Frank, some of that was amended, under President Trump. There's probably going to be an attempt to kind of go back to that. But there may also be some, so we'll have to be on guard for that. But there also may be some opportunities in the areas of, what credit unions can do in, for example, expansion of powers. Historically, Democratic administrations, Democratic lawmakers have been a little more willing to look at, say, expanded business lending or expanded field of membership. So, one of the interesting questions that we're wrestling with and would welcome feedback on is, in that sort of a scenario, what does it look like? Are we entirely playing defense, or are we also playing offense on, different issues? Which of course is probably the case in any example. But I think those are sort of the broad, sort of the broad strokes. And then, as Mike can surely tell you, and probably already has this morning, I mean, the need, the first 100 days, so to speak, I mean, the need is so great for, additional stimulus and, and just sort of COVID response, if you will, that since the first, the Democrats in the House and the Republicans in the Senate and the White House have been at loggerheads on a new round of stimulus for 2-3 months now, and it looks like they just passed a continuing resolution to fund the government till after the election, and it looks very much like they may, go home for the election now. So those issues are still going to be there.
Any other questions for Trey? Trey, when you say that there was likely a possibility of focusing on rolling back some of the regulatory reforms. That's not so much an attack on credit unions specifically, but
Right.
I think
Right. Yeah, I think in a, oh, go ahead, sorry.
there's a reluctance to treat credit unions differently.
Yeah, I think one of our biggest challenges with Democrats and progressives generally is that, you know, philosophically, I think they tend to get what credit unions are about. You're not for profit, you're in the communities, maybe a little more focused on lower and middle income people. But translating that and making sure that they understand that, you know, sort of the unintended consequences that sometimes come. And this was a big part, you all remember S2155 and our campaign around that, sort of educating well-intentioned lawmakers that, see abuses by larger financial institutions, needed consumer protections for people who are taken advantage of, but then don't see how those, if you're not careful in how you craft those regulations and those rules, how they can kind of flow out unintentionally and handicap the good actors in the system, like all of you who work with credit unions. So a big part of that's why we often talk about the credit union difference, because it really, really is critical to communicate that. And so a perfect example most recently is the Paycheck Protection Program. Washington is full of hearing stories about how they tried to get small business capital out the door very quickly to save these businesses. And then, the media reports that these large national food, restaurant chains or what have you get $10 million bailouts that came through because they had relationships with private bankers and so forth. And so the natural reaction is like, well, maybe we screwed up that program. It's incumbent on us to communicate. Mike will know these numbers better if I state them wrong, but the average credit union PPP loan nationwide was something like $49,000. So we did the right thing, and it's important. And this isn't just a Democratic or Republican thing; it's across the board. It's important that we share those stories about how we're there to serve that might not otherwise get served.
Awesome. Well, thank you so much for joining, Trey. Really appreciate your perspective. It was very helpful to get sort of the lay of the land there, and a lot of food for thought as we go forward.
Well, thanks for having me. Hope you guys have a rest of, I see Elizabeth hopped on, so she can delve into, speaking of regulations, she can delve into NCUA, CFPB, and all of that.
Thanks, Trey.
All right. Thanks, guys. Have a good weekend.
So, right, some of the other non-economic related or financial related questions that I saw in the list from Denise had something to do with the regulatory environment and specifically with NCUA, some questions around leadership and how that might change and what the implications of that might be, as well as what we've been engaged with at the agency recently. So again, I could do that, but better to have an expert on this topic. Elizabeth Eurgubian has been a colleague of mine for a number of years, and I'm sure if you've met her, she is definitely on top of her game and much better at presenting this sort of thing than I am. She does it on a daily basis, and she's one of our most effective advocates. Elizabeth is Deputy Chief Advocacy Officer and Senior Counsel for Regulatory and Executive Branch Relations, and she's agreed to join us to give a short overview of that perspective. And so, Elizabeth, take it away. Thanks for joining us. Really appreciate it.
Well, thank you so much for having me. And yes, I will, I'll talk a little bit about the makeup of the NCUA, a recent letter that CUNA has sent to the NCUA, and then also some of the top issues that they're working on right now and that we're, in contact with them and in discussions with them on. First, in regard to the board makeup, we have 3 board members right now. We have Chairman Rodney Hood, and then 2 board members, which are, board member Todd Harper and board member Mark McWaters. Now, as many of you know, board member Mark McWaters, his term has expired. It was up a long time ago. And there has currently been a new individual named Kyle Hauptman, who's been nominated by the president to replace Board Member McWaters, and he's going through the process right now. It's sort of taking a little bit of time, but we expect that he will be confirmed by the Senate by the end of the year. I'm not quite sure when that'll be, whether it's next week or in 5 weeks, but we're pretty confident it will be before the end of the year, and maybe within the next few weeks, from what my basic intelligence I've heard. But that changes every day, so you know, we're just tracking that daily, and that's our expectation as of now. So if he's confirmed again before the end of the year, this is Kyle Hauptman. He will replace Board Member McWaters on the NCUA board. He's a Republican nominee, so there'll still be 2 Republican board members, and then 1 that's a Democrat board member, which is Board Member Harper. And board member, a future board member, Kyle Hauptman, his term will be through August 2024. So it'll be a pretty lengthy term. Right now, Chairman Rodney Hood's term will be through August 2023. And board member Todd Harper, because he was sort of finishing up a leftover term, his term will actually expire April of next year. So he's up in 7-8 months. And that's the board makeup. Now, in terms of how the election impacts that, if the election goes in favor of President Trump and he wins, you know, we expect kind of status quo. We expect this board to continue on as they would. And then, you know, board member Harper, once his term expires in April, there'd be a replacement for him, but we'd still have the 2 Republican makeup with the Republican chair on the board. Now, if the election goes a different way and we have a Democratic president, we have still kind of an interesting board in that we have 2 Republican board members on the board. So even if we get a Democratic president and let's say, for example, Todd Harper is then appointed as chairman of the NCUA board, because Rodney Hood's term isn't up until 2023 and Kyle Hauptman's term isn't up until 2024, if they stay throughout that, which we've heard Chairman Hood would in that case, you would have an instance where even though you have a Democratic chairman, the other 2 members, board members, are Republicans. So there would have to be some collaboration in order to get certain initiatives through and certain rulemakings through, because you're still going to have a 2 Republican, 1 Democratic board. Now, if one of them leaves before their term is up, Hauptman or Hood, then that could change, and that individual can then be a Democratic appointee if we have a Democratic president at the time. So, you know, we'll monitor this throughout the year, but that's kind of the situation where we're at right now. Again, if we have the current president becomes president again, it probably would remain status quo. So right now, the board has been pretty active and busy in trying to help credit unions, particularly through the COVID-19 situation, and make sure that they're able to provide products and services to their members and operate as they have historically. And, you know, we've been giving comments to them throughout this time. You might notice that, you know, every few weeks, CUNA is sending a letter to the NCUA with additional recommendations on things that we'd like to see them look into or evaluate. And these letters are always based on feedback we get in the field, because I'm not working every day in a credit union, so I don't see what you all see. And we're constantly trying to get communications from credit unions and feedback from them so that we can incorporate those comments in our conversations and our correspondence with NCUA so that they could take rapid action and make things better for credit unions, especially now. So the most recent letter we sent was last week. Some of the comments on that were, you know, about excluding certain assets from the net worth ratio, because we know that since the pandemic began in March, credit unions have been flooded with deposits. This is something we hear very, very frequently, and I'm sure Mike has talked about and knows a lot about. So while most of these deposits are associated with members' federal stimulus checks, some of them result from a decrease in spending and also an increase in precautionary savings. So we've been asking for the NCUA to take that into consideration and to help credit unions in that regard. And we think it'd be important for them to amend the definition of total assets to exclude certain zero and low risk assets to help during this time for credit unions. And this is something that we've asked them to explore and help credit unions on. The other issue we've been asking for them, and we hear this is probably another very popular comment we hear from credit unions, is the need to capitalize interest on consumer mortgage loans. We've commented on that to the NCUA in numerous conversations and also in correspondence in April, June, as well as our letter last week, that we think the NCUA should permit credit unions to capitalize interest on consumer mortgage loans in connection with loan modifications made right now during the time of the pandemic. Now, the NCUA had put out some interagency guidance on loan modifications and troubled debt restructurings, but it's just not enough. And to further ease compliance requirements for these loan modifications, we want them to reinterpret the capitalized interest section of Part 741 in Appendix B to be consistent with the requirements of Fannie Mae and Freddie Mac, as well as some of the other federal financial regulators. So this is a very something we've been really communicating with NCUA, trying to get them to make some changes there. Another issue we've been talking about with NCUA is risk-based capital. And we know that they have, delayed the requirements for RBC, but we have been pushing that they further delay the effective date to January 1st, 2023, and to study this further and see if additional changes can be made to consider whether this rule is even practical at all, given what we've experienced this year. So that's another comment. And we know the NCUA is evaluating that right now. They're looking for ways that they could maybe make some changes there. And they are considering our comments in regard to RBC. Another issue is the share insurance, National Share Insurance Fund equity ratio. And, we've been ongoing in our conversations urging NCUA to forbear on any assessments consistent with the forbearance toward distressed members the agency has urged credit unions to embrace, and the lower prompt corrective action and capital trigger thresholds for required supervisory action the agency has also adopted. So this is an ongoing comment we have with NCUA that a temporary forbearance approach to the existing NCUSIF equity ratio policy on levying insurance premiums is something that they should absolutely do. Other comments other issues that the NCUA has been working on that we've been providing feedback on. Another compliance burden for credit unions is, of course, CECL compliance. And Chairman Rodney Hood has really been pushing FASB to exempt credit unions from all of these new CECL requirements. That doesn't seem like it's a possibility at this point, but we have been encouraging NCUA to move forward with this phase-in approach to FASB, or to CECL. And that's something they're working on right now. And we're also urging NCUA to focus more on CECL compliance guidance and resources for credit unions. And so that's one of our top issues. And just to note that FASB did delay the effective date for credit unions until 2023. So that's one thing in our favor, but this is an ongoing issue that we're working on. The other issue we're working with NCUA on is subordinated debt. They had a proposed rule on subordinated debt to help credit unions out, and we commented on that with very lengthy comments letter over the summer. So right now they're in the process of considering those comments in response to the proposed rulemaking that would allow, low-income credit unions, complex credit unions, and new credit unions to issue subordinated debt for purposes of regulatory capital treatment. So we're supportive of this. We did have some constructive comments, but we really wanted NCUA to evaluate this and get something final soon. And we've been communicating that to them. Another issue is on the central liquidity facility. We know that Congress made some changes there to help credit unions as part of the CARES Act. And unfortunately, under the CARES Act, the temporary changes to the central liquidity facility are going to expire. So, we have been encouraging Congress to extend those deadlines, and we've been encouraging NCUA, and they've had many comments or many communications with Congress to also extend those deadlines. So what we're all kind of asking Congress to do is extend the expanded borrowing authority in the CARES Act to at least December 31st, 2021, and also make permanent the ability of corporate credit unions to act as agents for credit unions with regard to the CLF, and to authorize the NCUA to expand the Central Liquidity Fund's borrowing authority from 16 to 25 times the paid-in capital. So these are things that we're pushing, as well as Chairman Hood's pushing. We know Board Member Harper's also pushing the Hill for some of these changes. I mentioned risk-based capital. Another proposed rule that the NCUA has, and this is sort of taking what they've done in practice and just kind of putting it, memorializing it in a rulemaking, is on credit union purchase of banks. This was kind of a big issue before COVID-19. We don't hear much about it now, but they have a pending rulemaking that they should be finalizing soon that will clarify and make transparent the procedures and requirements that are currently in place for these combination transactions or transactions where a credit union purchases the bank. We don't expect new red burden with this. It's just kind of taking what the office, the NCUA has been doing in practice when evaluating these transactions and putting it in writing so there's transparency there for the industry. Other things we've been asking for, of course, are longer examination cycles for credit unions right now, especially given the time that we're in. And we've been actively pushing NCUA to extend the examination cycle for credit unions with under $3 billion in assets to like more of an 18-month period to be consistent with what the prudential regulators do for the banks. And of course, we're in ongoing conversations with them about streamlining their examinations as they're moving to more virtual examinations, making that process as easy and seamless for credit unions as they can, because we want credit unions to concentrate on their members. We don't want them concentrating on collecting paperwork for the NCUA that's superfluous or could be found in other ways. We want them to concentrate on serving members and helping them right now. So that's something we frequently communicate with the NCUA. And another thing we communicate, we get this feedback from credit unions on exam consistency, where one credit union will tell us an examiner cited them or it provided feedback to them that's really inconsistent with what we're hearing in another region. And also inconsistent on many issues with what we're hearing from the central office in Washington. They might say one thing, Chairman Hood might express something in a speech that's wonderful, but then the examiner does something totally different during the exam. So in our conversations with the board, we frequently bring that up. And if we get examples where there is inconsistency among examinations or from what the Washington office is telling versus what the examiner is telling in the field, we communicate that to NCUA. We have many meetings with their examination staff and also with the board members on these issues. So if you ever hear of any issues like that that we should be aware of, it'd be great to communicate that to CUNA so that we could take that and communicate to NCUA in our meetings and also in our letters, because that's an ongoing theme I hear throughout the years, and we want to make sure that exams are consistent across the industry. Of course, they're looking at other ways to modernize the call report, so we should hear some update on that fairly soon. And just other ways to reduce regulatory burden for credit unions, especially right now. We have a friendly board. We are trying to come up with anything we could think of that will help credit unions right now. So again, any ideas that we should be delving into further that we aren't, we're very open to that, because we want to capitalize on what the board that we have right now, because that could always be subject to change in future months. So I hope that covers, kind of gives a pretty good overview. I'm happy to answer any questions or follow up if I don't have answers to your questions right now.
Wow, Elizabeth, what do you do with your free time? You guys know that consistently through the years, I brag about the advocacy team at CUNA. I talk quite frequently about how they're engaged 24/7 at 365 days a year. That may be a little hyperbole, but you can tell from what Elizabeth just talked about, it's a ton of work, and they're really making great strides in advocating on your behalf and making operations easier to the extent that we can. Elizabeth, you mentioned that, well, actually, let me pause there and see if anybody has any specific questions or comments for Elizabeth. Okay, so since I didn't hear any, let me just ask you real quick before you go. You mentioned that the current board is relatively friendly. And you also said that, you know, if we end up with, in one scenario, we may end up with a Dem in the board chair position with 2 Republican board members. In that situation, do you think that things would be substantially less friendly? I mean, it is striking that even though there are political differences on the board, but in the current environment, and I know you have, you know, many years of experience in the depository industry interacting with regulators, it feels to me like even though there are these political differences, that things are getting done and that they're, you know, in a pretty good place. Do you see that maybe changing if we end up with a different chair, or would you expect there to be, you know, pretty much business as usual?
You know, it really depends. Like, I think if we keep with the chairmanhood, we'll probably end up on the same path we have been the last several months, you know, last couple years. So that's positive. If it goes to a, you know, my guess is if we have like a President Biden, and again, this is guessing, I would guess that because board member Harper's term would be up in next April, that they might just make him chair. And then put Chairman Hood now down to a board member. He could stay. He said he would. You know, that's up in the air whether that would actually happen in practice. But I have a feeling that a President Biden, should that happen, would make Harper a chair because it's not that long, and then he could then replace him with whatever chair he wants in April. Yeah. After some thought can be given to the position. Now, again, I'm just guessing. This is what I would do if I were him. Yeah. And in a case like that, let's say you had a situation with a board member Harper, who's now Chairman Harper, and a board member Hood, and a board member Kyle Houtman. I think on certain issues, yeah, they probably could be some collaboration. You might see some rulemakings on some of the safety and soundness things. But however, a Chairman Harper does have a lot of ideas with regard to consumer protection that may not fly with, you know, a board member Hood and a board member Houtman. You know, like adding more examinations and delving into some of the issues further. I know one example I could give was Chairman Hood wanted to move forward with a proposed rule, an interim final rule actually, on overdraft protection, which would have made a very minor change to a policy on overdraft, which would have allowed members to resolve overdrawn accounts within a flexible period of time rather than that 45-day time limit that's required with the current regulation. This is not a major change. It's fairly benign. But board member Harper wouldn't vote for it. It's on overdraft. That's a consumer issue. He wasn't going to let that go. So his vote was going to be against, and they had to table the rule. So I think when you see stuff more on consumer protection issues, you might have some conflict there between like if a Harper and, you know, Republican board members. But on some of the other issues, you would also see it on RBC, like anything RBC, you're going to see some conflict. But on some other issues, maybe with CECL, maybe on examinations, subordinated debt, some of those issues, I think they're all on the same page, relatively speaking. But anything with like RBC or consumer protection, they're not on the same page. So there's going to be difference of opinion there.
Okay. Great. Well, thank you so much for joining us. I really appreciate it. I know you're super busy, but I do really appreciate you joining the call and helping us sort of noodle through some of the possibilities going forward.
It's my pleasure. And, you know, again, I just want to reiterate anyway, either through Mike, if you have comments, if there's something that you think we should be looking at that we aren't, if you want to give some feedback on an examination or anything, we're super open to that. We don't say who we get the comments from. We make sure that's all anonymous in our communications. But it really helps us because, I mean, I worked in a bank. I've been through exams. I had a cease and desist, all that crazy nightmarish experience. I've been through that. So I know that your experience is very different and unique compared to what I see in Washington, D.C. So we're always open to any feedback, and we take that to our meetings and we use it to educate ourselves. So please feel free to provide that to Mike. If there's things we should be following further, we would love to know about that. And we're very open-minded to any feedback you have, and we use that in our meetings. So I encourage that. Thanks, Mike.
Yeah, thanks for all your hard work and thanks for joining. Talk to you soon. Okay, that leaves us with about 6 minutes for questions on any of those topics or on the economy, credit union operations and stuff that I talked about. I hope that you found Trey and Elizabeth's participation helpful. You didn't have to listen to me drone on for another hour, which was probably a good thing. But I do think that they have a lot more in the way of insights than I would have on either of those topics. And so I hope you found that helpful. And we'll just pause and see, are there any follow-up questions, comments, concerns, disagreements with maybe what I laid out or what Trey or Elizabeth laid out, and anything along those lines. I think that means that Ryan is probably taking a bathroom break or something, because he had a pretty long list of complaints earlier in the week. Hey, what do you think, Denise?
Mike, we got one question in the chat box.
Oh, good. Okay.
The question was, do you think the tax exempt status of a credit union is at risk if Biden wins the presidency?
I think the tax exempt status of credit unions is at risk no matter who's in the Oval Office. We've spent so far over $3 trillion trying to stabilize the economy. We're going to probably spend a couple trillion more. It's almost like monopoly money at this point. At some point in the future, I don't think it'll be in the next year or year and a half maybe, but at some point in the future, the risk of policymakers looking to fill the gaps, looking either to, obviously they'll be looking for ways to decrease spending, but they'll also be looking for ways, and again, this is no matter who's in the Oval Office, they'll also be looking for ways to raise revenue. And I don't think, in the past, the issue was that, and it was pretty easy to fight off because it was the vested interest of for-profit bankers urging policymakers to tax credit unions. This time around, that's not the issue. The issue is a real significant budget issue that affects everybody. And we won't take the bankers to suggest this. We believe that policymakers will be looking at ways to level the playing field, not coming after credit unions specifically, but coming after anybody that has a tax advantage of any sort and trying to eliminate those tax advantages. So, I believe that, it's not just me, obviously, but a lot of the folks that I talk to are very concerned about that possibility a year and a half, 2 years down the line.
So if you don't mind me adding to your comments, Mike, this is Joe in Vermont, and I know at a league level with my counterparts across the country, when we meet every couple weeks, that's not just true in Congress, it's amplified by as many state legislatures as there are out there. And to the extent that state governments are going to have these holes to fill, legislators are going to be looking for ways to fill those holes. And like you said, it's not going to be targeted at credit unions, but credit unions will be one of the possible solutions that they all look at. And I know in our legislature, legislators are looking at the list of tax, what do they call it? Tax expenditures, I guess they call it in Vermont, probably most legislatures. The tax exemptions, and seeing what the value of those are. And they look at that list every legislative cycle, so every 2 years for us, and they go down the list. And the further up on the list you are and the size of the tax expenditures for the state, the bigger target you are.
And, we used to be able to say historically, we can still say it, but I don't know that it has the attraction or gravitas or whatever. But we would say, given the value that credit unions deliver in the marketplace, roughly in the last year, roughly $16 billion in direct financial benefit, lower loan rates, higher savings yields, fewer and lower fees. That 16 billion is in the context of roughly 2 billion that would be raised if Congress taxed credit unions. And that was back when we were earning 93 basis points, not 50. So, $2 billion runs the government in the old days, a year ago, for about an hour and a half. And so, the squeeze isn't worth the juice is something that really resonated with policymakers, certainly at the federal level. And I'm not so sure that carries the same weight or will carry the same weight. But we're very, very concerned about that. Well, it's 11 o'clock, so I should probably just pause there. And I'm more than willing to hang out if people have additional questions. Don't have another meeting for about an hour, so I'm more than willing to do that. But I just wanted to say thank you for having me. I really wish we could be together, and hopefully that happens sooner rather than later. I know GAC is going to be virtual, so I won't see you guys at GAC, but hopefully sometime between now and next October, we can get together and actually have a little bit of fun too.
Thank you, Mike. We really appreciate you taking the time. I know how swamped you are during all of this COVID stuff, but thank you. And yeah, we are missing big time our socialization here at the Fall Forum this year. No McDonald's, what can we say?
Yeah, I tell you, I like being at home. My family is great. I don't know if they like me being at home, but I like being at home. But I do miss everybody, and best wishes to you. And I'm here for you if you need anything. We have a bunch of resources on our website, www.cuna.org/economics, that are related to financial stuff. So we have the peer analysis report. You can type your charter number into the peer analysis report, and it will, develop a pretty comprehensive overview of you compared to the 6 credit unions closest to you in asset size in your state. Or you could limit it to lid credit unions, or you could actually pick out 6 credit unions, no matter where they're located, that you might consider to be your peers. So that's kind of a handy thing. We have a capital planning calculator, crisis edition, which compares, basically what happened to your credit union back in the Great Recession and allows you to generate forecasts going forward. Kind of a handy thing, especially for board members to see. And a couple other reports that you might find useful. I can't remember if I told you this last time, but we now have the ability for each of you individually to go into a tool called the Economic Impact Calculator, type in your charter number, and it will spit out the economic impact that your credit union has in its local community. An awesome, I think, a really awesome tool that, allows you to brag not only to policymakers, but to your members as well, to show them, exactly the impact you have, which is in most cases an eye-opener, really. So I'm here for you if you need me. You know how to get a hold of me. Thanks so much for having me.
And thank you, everybody. And I will send you the link of this session. I'll also send you Mike's PowerPoint. You can have that. Thanks again, and have a great weekend, everybody.